Hello, and welcome to the 5th episode of Onward, the Fundrise podcast, where you can find out more about what's happening at Fundrise and where you'll hear some in-depth conversations about the big trends affecting the U.S. and global economies. My name is Cardiff Garcia. I'm an economics podcaster and co-founder of Bazaar Audio, and today's episode is being recorded on June 30th, 2022. And I'm joined, as always, by Ben Miller, CEO of Fundrise. Ben, hello.
Hello, Cardiff.
So we have a really exciting episode today, Ben. It involves a big announcement for Fundrise investors that you're about to share for the first time with our listeners, and that you and I are then going to discuss. And then afterwards, we are going to bring back to the show Kendall Davis, who is the head of investor relations and investor operations at Fundrise. And the two of you are going to field some questions from listeners and from Fundrise investors and answer those. We did that last time. It proved to be hugely popular, so we're going to do it again. But without further ado, Ben, I think the suspense is probably killing everybody. So why don't you unveil this announcement?
Oh, wow. Okay. Well, the big announcement is that Fundrise is going to expand beyond real estate into a new asset class. We're building out an initiative to invest in private technology companies, and we're launching an innovation fund to invest in mid to late stage private tech companies.
Tech. You're going to become tech investors.
I know it's a contrarian moment for everybody because tech is down on its heels. But yeah, basically it's pre-IPO tech, not just public technology companies. You know, the last 10 years, private tech companies have been incredible investments. Most private companies haven't been going public. And so private tech has actually maybe been the best investment in the world over the last decade. And individuals pretty much are barred from investing in it. They're like, normal people can't invest in private tech. And that's something that sort of flies in the face of our values. So we are going to go after that market.
I think there's a sort of obvious first question, which is about the timing. So why now? You alluded to the fact that this is going to seem like a bit of a contrarian bet. And we know that this year, the valuations for private tech companies, along with the valuations for every other risky asset pretty much, have come down. Do you think that there's an opportunity, especially now? Is this something you've had in mind for some time? Tell us a little bit about that.
Yeah, tech market's been falling this year, and I think will keep falling, which makes it the perfect time, actually. That's fundamentally contrarian. It's still early in the tech collapse from the bubble last year. And so I think our expectation is that we're not going to hit the bottom until next year, 2023. But that collapse or that sort of cycle creates a once-in-a-generation opportunity. It hasn't happened in basically 20 years.
And is this something that you've been looking at for a while, or is this a recent idea of yours? Can you kind of give us some insight into how you developed the thesis and why you're choosing to pursue it?
So we have been thinking about expanding beyond real estate maybe from the beginning, because that's 10 years ago. We wanted to make sure we'd gotten to scale. We really had our systems in place. We're executing. And we've been considering tech because tech is so fundamental to our views of what is a great investment. But only in the last 6 months did it really open up that the actual collapse of the tech market is what made us so interested in entering it. Because what we think is going to happen, right, is that it's going to go from worse to even worser. I'll say that again. It's going to go from bad to worse. The Fed's going to drain liquidity out of the market, and we're going to see pricing fall, multiples fall to historic lows. And so it's like real estate in 2009 and tech in 2001. And if you think about it, right, we started Fundrise in 2010, 11, 12, after the last financial crisis. And we started with real estate because real estate basically was at the bottom. And so now we're looking at tech. I actually worked in tech in 99 to 01. And I remember in 01, tech was left dead in a ditch by the side of the road. And so being contrary to sentiment, I think is really critical to good investments. And if you look at, forget about pricing, forget about sentiment, forget about today, just think about what are the big drivers in society? Demographics, globalization, war, disease, and technology. So technology is fundamental, and Moore's law is arguably the biggest driver of change in our society. And that hasn't stopped. It maybe has slowed a little bit. It hasn't stopped. Cost of compute is falling, will keep falling. TSMC has a 3 nanometer chip coming out. And that's basically going to open up more of the market. And so we're seeing a cyclical decline, but in a permanent change. So we're really excited about it. I think we have a lot of interesting ideas for how to do it differently. And so what better time than now?
I like describing it as worse and worser. And then, of course, the best time to get in would be when valuations are at their worstest, if you want to keep going that route. So let me ask you this. You said that you expect the route in tech valuations to continue and that you might not hit the bottom till 2023. Are you going to try to time it so that you start deploying money at that point? Or do you think it's better to get in as it's falling when valuations still look good, even if they have some small way to fall after you start getting into the sector?
That's a tough question. So partly we're lucky, not smart. We'll launch this fund in July. It'll start small and we will execute very deliberately. If anybody's watched us over 10 years, we're very deliberate in how we do things. And so we're going to start small by necessity as we get a conviction and build out essentially our plan to execute. So by the nature of the timing, we really won't be investing meaningful amounts of money till next year. I think we'll invest some this year. It's important as we get into the market. If we can find some good investments, we'll take them. But one thing we won't do, at least not intentionally, is we are fundamental investors. So if something is frothy, something's hot, we're not going to invest in it just because we have money to deploy. That is not how we're structured. So the more important thing, and I think I said this on the last podcast, is to get invested in the best companies. The best companies at a good price is way better than a good company at a great price, especially with technology, right? Facebook, Google, you name the companies that exploded. And those companies would not have taken our money last year. In 2021, it was a bubble and they had everybody throwing money at them and you could not get into the best companies. Times have changed and those best companies are much more open-minded than they were.
There's a lot to discuss here. And I think my next question, though, is what kind of technology companies are you looking to invest in? Are they companies, for example, that are specialized in something that has to do with real estate technology, which of course would complement the rest of what Fundrise does? Or are you looking at the broader tech sector? Give us some insight into the kinds of private tech companies that you're interested in looking at.
So we, Fundrise, have two capabilities. Right? We're a fintech company. So we have something about finance and we know something about technology. On the technology side, most people don't know this, but a typical VC fund would only have 5-10 people working there. And of the 2,000 venture funds in the country, I would bet you not a single venture fund has a product engineering department, which we do. Right? We have 100 engineers on our team approximately. And so we have a lot more technology capability than most venture investors. The type of technologies we're interested in, we actually use. We use Fivetran, we use Snowflake, we use Figma. So it's not just theoretical. And our team, like our engineering team, has built, we have cloud and data infrastructure, we have payment processing, we have APIs, analytics, cybersecurity, and we're getting attacked by Russia, China, North Korea, probably daily. So we really have depth on the technology side. And we also have a huge digital marketing team, and we invest tens of millions of dollars in digital marketing. So we know about how to scale a company. We know about unit economics, basically essential B2C execution. So we have a lot of depth on the technology side I think is very useful when we think about like how we can look at and connect with great tech companies. And there's this axiom in VC that founders and executives make the best VC investors. So you'd think after 10 years of building Fundrise that we have expertise to bring to bear.
You are a technology company, in other words. That's part of the thesis, is that in some ways, Fundrise is a technology company. It's an investment platform, but it is also a company that develops its own technology, uses some of the kinds of technologies that might be similar to the technologies of the companies that you might be investing in. And that seems to be a core part of what you're doing here.
Yeah. So, part of our thesis, and this is going to take time to develop out, but we are using technology to do the venture investing, not in the way people think of with like algorithms and Zillow and nonsense. That's just silliness. But because we build products, we're product people, we have interesting ideas of how to use technology. And that's something, again, will take us probably 2 to 3 years before you see meaningful products out of it. But it's not even something venture industry is trying to do. Like the top 10 venture funds, top 20 venture funds, as I said, they don't have product engineering departments. They're not trying to do this. And I think that that's crazy, right? Every single industry has been disrupted by technology. Why not venture? So that's the tech side. And on the finance side, we're one of the biggest real estate investors in the world. We probably, by deployment, are around the top 20 biggest real estate investors in the world. In the first half of this year, 2022, we invested more than $1 billion. So we have an enormous scale that we can leverage for our investors as we invest into tech. And a lot of great tech investments these days actually are asset heavy, but venture investors can't invest in asset heavy businesses. They want to invest in sort of asset light businesses. It's interesting. Most venture players actually are pure play venture. They're not like a multi-asset class. I have an example of that. We actually have done this. We actually created a partnership with a company called Saltbox. And that company is, you can think of it like the WeWork of industrial. So in the industrial space, typically a building's 100,000 square feet or 200,000 square feet. When you lease 10-year leases, 5-year leases to large credit tenants. But what happened in e-commerce is that there's this huge growing industry of people who are Etsy sellers and Amazon sellers and Shopify and eBay. And they have no place to do it. They do it out of their garage. A lot of them have huge businesses, they're shipping 100,000 units a year. And so Saltbox created this business where they create the infrastructure underneath these companies. They lease to them and provide sort of different kinds of services. And that business has been going gangbusters. We invested into the parent tech company. And then also we're buying the warehouses to lease to them and building them out for them. So we put $66 million into the real estate and only $1 million into the parent. So it was sort of a beginning of looking at how you can leverage our two capabilities to do things that are special.
You hit a lot of different beats there. So you talked about how you're going to use technology to try to disrupt venture investing itself. You talked about this partnership that you've sort of, it sounds like from what you've done in the past, you're sort of trying to mirror some of that process in the fund that you're starting in this new venture, right? And then you're talking about how you're not limiting yourself necessarily just to real estate related technology companies. You're going to invest in companies that perhaps have sort of specialized in the technologies that you're still familiar with as a real estate investment platform, but you're not limiting yourself to that. Is that roughly correct?
You're the best, Cardiff. You know how to recapitulate.
It's good to pause every now and again and just signpost where we are and where we're going. So in terms of what's next, I want to talk about some of the advantages that venture capital firms do have and sort of define how you view your competition essentially and see what their strengths are. And then afterwards, we'll talk about some of their weaknesses. Venture capital firms, maybe a place to start is with just the fact that they have a lot of money to deploy right now. They have a lot of dry powder commitments from their investors. And so as you look to invest in tech, you're going to have some other folks with money to get rid of who are also going to be eyeing some good opportunities. So how do you make sure that you've got an edge there, that you find the companies that maybe they're not finding, and also that you invest in them on good terms rather than getting into bidding wars and things like that?
Okay, that's a doozy of a question.
Yeah.
We may have to break it up. So
I'm asking you to compliment your competition. Yeah, that's right.
Yeah. Well, let's take it in pieces here. So let me start with some basics. So what is a venture capital firm?
Yeah.
Satirically, it's 3 guys, a potted plant, and a checkbook. I mean,
that sounds vaguely insulting, but please continue.
Oh, yeah. I was supposed to be complimenting them. To most VCs are really small teams. So like a $250 million VC fund is 3 to 5 people. So you're not up against a lot of people. And what is their background? So the industry's really changed over the years, and it's made up of mostly investment professionals. So that's somebody who was an investment banker, management consultant, they got their MBA, they became a professional investor by working at a VC or private equity fund. And we've seen this movie before. It's the same thing happened in real estate. Real estate used to be made up of real estate people, and now real estate private equity is made up of finance people. And that's true with pretty much all of the $10 trillion private equity market. So you have venture where very few venture investors were engineers that built products. It's not a product first industry, it's a finance first industry.
Or like an MBA first industry or something like that.
Yeah, exactly. So here's the narrative I think of when I think of what VCs say they do. The analogy is they're a music talent scout. And the story goes, they go out and scour the nightclubs and bars and find the unknown musician. They have a special trained ear for great talent. They discover the talent, they produce them, they distribute them, and they sort of make the talent. That's like the popular notion of VC, and that's what the VCs say. Like they're value add VCs because they do all these things. And so like what I'm going to say is like contentiously is that was true at one point, and over time that's become less true. So question is, how true is it now? And is that really the exception to the rule? So let me just go back in time for a bit and do a brief little history lesson, unless you want to recapitulate anything.
No, I think this has been easy to follow so far. I'm actually kind of excited to hear how the history you're about to give us relates to like the current strength of VCs and what you're sort of up against.
So, okay, I'll call this section That Was Then, This Is Now.
Okay.
So VCs basically invented in the 1960s, maybe 1970s, right? It's hard for people to realize how there was really no money for people starting companies. Even the idea of people starting companies wasn't even a notion. And the initial sort of creators of the venture industry, like Arthur Rock, Eugene Kleiner, Don Valentine, really created this concept of great entrepreneurs and technologists can leave and get money and start a company, because before they couldn't. And those people created Intel and Apple and Cisco. And if you think about it, there's no option but Arthur Rock or Don Valentine. They were getting huge parts of your company. So if you think about the sort of structure of the industry, before there were very few companies, very few people starting companies, there were very few VCs, and there were very few dollars for those VCs, very few LPs. Like it was a novel idea. People were unsure about it. And now there are probably 20,000 companies to invest in, 2,000 VCs, and venture market something like $600 billion. So a lot has changed in terms of the scale of the market, but actually the basic like model of the VC, how much they get paid, how they do their work, hasn't changed. There has been essentially no meaningful innovation in venture capital over those 50 years. Like Eugene Kleiner could see the industry today. He might be surprised by the scale, but not the methods. Like the biggest innovation in venture in the last 20 years has been bigger checks. Like SoftBank started that with Yahoo in 1999, and then DST, basically really changed the market, I think in 2009. So big checks, more money was the big innovation. It's not a huge innovation as far as innovation goes. And so the corollary of that is that what the VC does with a robust market and lots of data, and data has become transparent because of technology, what they do is very different than what they used to do. Where they used to identify great entrepreneurs, Steve Jobs, and people would look at him and say, who's going to back him? They backed him, and he's genius. But now what's happened is with the expansion of the industry, all that money allows companies to stay longer, they delay going public, and then these private companies become sort of enormous consumers of growth capital. So I'll give you an example. Benchmark, who's a top venture firm, they funded Uber's Series A, which was a pretty remarkable call on their part. By the time Uber went public, of all the money Uber consumed, how much was that initial check by Benchmark? 0.1% of the capital Uber raised. Uber went on to raise 1,000 times more capital from that initial Series A. Benchmark identified them, but what actually became most of the venture industry, right, the other 999 checks that got written, right, was follow-on investments, right? The identification had been made, it had metrics, it had product market fit, and it became about access. Access is what the venture industry now lives on, not identification. And one of the reasons why all the founders, you saw all these really bad stories about founders and excess and bad judgment and bad governance, is that the founder controlled, or the CEO controlled access to the next round, and the follow-on or later stage investors would basically give up whatever they could in order to get the access. It wasn't about finding the diamond in the rough, finding the musician at the music bar that no one knew about. it was about momentum investing. And VC became about momentum investing, and that became a bubble. That's what momentum investing does. It creates bubbles.
It also sounds like the thing that was scarce sort of got reversed, right? In the past, the thing that was scarce was the money to fund your idea. Now, there's just a ton of money in the space. The thing that's scarce is access, as you defined it, to the great ideas, to the great companies. And certainly, I think over the last roughly 10 years, there's been both very strong reported performance from venture capital firms, but also it's been an environment where everybody's trying to chase some kind of a positive, strong return. And so there's just a lot of competition for where to put your money into rather than competition for the money itself. Do you broadly believe that story? Do you see any basic holes in it? Is that sort of your assessment of where venture capital is right now?
Yeah, it's a challenge. There's another set of data out there by Cambridge Associates.
Yeah, they chronicle trends in VC. They look at performance trends. They look at who's raising a lot of money. And they look at, again, reported performance. And then there's realized performance, which is when venture capital funds actually return money to investors instead of estimating how much their holdings are worth and just reporting that.
Right. So this data is from mid-90s to mid-2015. So basically, it's over about a 20-year period from 1995 to 2015. So it's before the recent bubble. They said, how much of the returns to venture are from the top 100 venture investments? And basically, it's 80 to 100%. So the top 100 companies are responsible for all of the returns. And actually, like in some years, like in 2009 and in 2001, where most of the industry lost money, the only venture investments that made money were the top 100. So there's some years where the top 100 are responsible for 200% of their venture investments because the other ones lost so much money. So that challenge, let's say the top 100, you have $550 billion, 2,000 venture funds chasing 100 companies. So the scarce asset is no longer the money, which is more and more true in finance, right? The financial industry is actually designed around the money, but actually money is becoming less scarce over time. It's become more commoditized.
One of the things about investing through venture capital is that there's a very strong incentive for venture capital firms to essentially never write down the value of their holdings before they actually sell them and give the money back to investors, because you don't want to be the one venture capital fund that says, oh, actually, from this quarter to the next quarter, from this year to the next year, our valuations went down of the companies that we actually own. And so there's a lot of skepticism about the reported returns themselves. I'm wondering if you have any thoughts on that and how you're going to try to avoid that incentive structure in the fund that you're actually creating now for Fundrise, how it applies to you essentially.
So that gets at a little bit of some of our advantages compared to the incumbents. I think of it as three categories. So technology, we have technology, we're going to build technology. They have no technology. Whether or not that matters remains to be seen. But if past is prologue, normally technology is an advantage. So that's one. But let's talk about structure and incentives. So I break it up into sort of a few different pieces. So time horizon. So time is an incredible asset for a company if they're trying to basically do real innovation. So the story is VCs are long-term investors. But in practice, the real constraint is they have a closed-ended fund. And that means that the fund has to wind down and sell all its assets within 10 years. So at most, they're a 10-year investor. But in practice, the venture firms that everybody's heard of raise money every 18 to 24 months. They say, okay, I raised fund 2. We're deployed over 18 to 24 months. Now we got to raise fund 3. When you go out to raise fund 3, what do you need to show to investors? That fund 2 is doing really well. So fund 2 has to mark up its assets before you can raise fund 3. So what do companies have to do? Companies have to go out and raise another round. So when everybody says, why does any tech company raise money every 18 to 24 months? It's not because companies have some natural cycle of innovation over 18 to 24 months. It's because their venture investors need to mark up their investments so they can raise the next fund. So that's very short-term thinking. 18 to 24 months is a difficult timeline to achieve anything meaningful. And so that structure drives incentives to be short-term for venture investors. Momentum, more money, faster markups. In theory, more money, you go faster, but you can't birth a baby faster with more money, right? Real things take time.
Yeah, I love that metaphor, by the way. I want to just interject here too. I take it from what you're saying here that Fundrise is not going to be raising a second technology investment fund in 18 to 24 months, correct? We can rule that out?
Right. So our fund structure is an evergreen fund. And so the fund is like our flagship real estate fund, except for tech. And it's a perpetual life fund. Evergreen fund is a long-term fund because basically most of our investors are young. And one of the craziest things, you'll look back at like Sequoia, they invested in Apple. They actually invested in Apple when they were starting. And right before they went public, Sequoia sold all their shares in Apple for 6 times their money. That was a great return for, I think it was fund 1 or 2 for Sequoia. So it was really good for that fund to show they could raise their next fund 6 times. If they'd held it, they would have made 24,000 times, right? So that's like the disincentive. And what founders hate is you build a company, you go public, and then all your venture investors dump all their stock because they have to return the money to their investors. And so we're a crossover fund. We can hold public and private because I think that basically the public-private distinction is meaningless. It's a regulatory distinction, and we basically think it should be torn down. And so why would you want to pay tax, realize tax, and exit great companies just because they're now trading?
Yeah. Is this sort of related to the idea that public and private markets are converging in another way, which is that the big public market companies, Alphabet, Apple, Meta, et cetera, those are all tech companies now. Like the big mature companies are part of the tech sector, which is itself now, you could argue, quite a mature sector. And so I'm kind of curious to know if that's something that you've observed, that there is an increasing convergence between the two. And you describe it as just a regulatory distinction, but what are some other ways in which you think those lines have blurred?
There's a bunch. I love that question. So another is cost structure. Typically in the public markets, everybody recognizes public markets have become efficient. Later, I'll argue that venture markets have become a lot more efficient too than they used to be 20, 30 years ago. But in private markets, typically a fund manager, whether it's venture or real estate or any other private equity investment, they're usually paid about 2 and 20. So 2% annual asset management fees and 20% of the profits or 20% of the upside. That is highly unusual in the public markets. And so 2 and 20, again, like when Eugene Kleiner or Don Valentine made investments, like they justified that and then some. But now with 2,000 venture funds and essentially the way deals are auctioned, is it really justified? Less and less so. So our fund has no 20% carried interest. It doesn't take any share of the upside. And I would say there's probably not another venture fund in America that would do that. It's very disruptive not to take 20% of the ups.
Specifically, your fee structure is just a share of the total amount, almost in the same way, I don't know, a mutual fund works or something like that.
Right. And our fund structure is a 40 Act fund, so it's very similar to a mutual fund. And so the idea is, this is like deeply ingrained into our values at Fundrise because of the 2008 financial crisis. If you're going to get 20% of the upside, then you should pay 20% of the downside. If you're not going to pay 20% of the downside, then you don't deserve 20% of the upside. That's just not right. And it creates skewed incentives. It's a risk-on incentive, right? You get paid to take risk. You don't get paid not to take risk. And so one of the hardest things you saw it last year in the venture investment industry was not to invest the money. And that was a terrible mistake. I don't think there's a venture fund in America that didn't put out meaningful amount of money last year at absurd valuations. And that's because their incentive drove their behavior. So that's another really distinct difference between us and traditional venture funds.
Yeah, is that cost structure. And I'm kind of curious to know about how you're going to be communicating with investors, how often and what kinds of information you're going to be able to share with them as you start putting together the fund, raising the money, and then eventually deploying it.
There's another big difference, right? So typically venture investors raise their money from institutions. Those are endowments and pension funds and family offices. And so to date, as far as I know, there's never been a venture fund that raises money from tens of thousands or hundreds of thousands of individuals. So we're unique in that. We're going to be democratizing investing into venture. So having 350,000 investors and 1.6 million users is very, very different from a venture fund that might have 20 institutional investors. How we report to investors, the kind of like real-time information, the kind of transparency we embrace. Here I am saying, I don't think there's a secret sauce. There's not some inside information I have on some tech company. We're going to provide a lot more content to our investors than normal. And I think that having 350,000 investors is going to be a huge asset for us.
And Ben, I hate to keep trying to get you to say nice things about your competitors, but before when I did, you gave us sort of a history, and what you said was that actually VCs have been super staid for like half a century. So they've been consistent and they've raised a lot of money. So maybe those are their strengths. But is there anything else that you'd say about the advantages of the incumbents, the venture capitalists that you're going up against now?
Okay. Sorry. You're right. I got distracted by my desire to critique the competition. So one of the things about venture that's really interesting compared to, let's say, hedge funds, if you look at the top hedge funds versus top venture funds over the last 20 years, is that venture funds returns are much more persistent. So the top hedge funds in 1 year are unlikely to be the top hedge funds the next year. But in venture, the top venture funds usually stay the top venture funds. What's that advantage? They have something that's basically giving them more persistent returns.
Or a lack of competition. One or the other.
But there's a lot of money in this space, right?
Yeah.
Part of it is they're really smart and they're so trained and experienced and so smart. But there's a lot of smart people in the world. So the best idea out there is essentially brand. So the top VCs have really strong brands. And the argument goes that if a founder is looking to raise money and they can get backing of a top tier venture fund, that's going to give them strong signal value of their future success. I mean, if you look at any article, it always says some company and this is backed by Sequoia. And that will help them raise their next round because it's signal value from the Series A to Series B to Series C. It attracts employees. It helps customers feel comfortable about the company. So I think brand is probably the biggest benefit or advantage of these companies.
That's interesting also because I'd imagine that if at some point the fund does find a really interesting opportunity and it just so happens that, let's say, Sequoia has also discovered this company and the company's trying to decide whose money to take, they might say, wait, aren't you the real estate guys? What are you doing here? Whereas with Sequoia, I know them, I can put Sequoia backed and maybe they've got somebody over there who has coached previous founders before and they'll work with me on things like that. So it sounds like that would be also something that you'd be going up against, partly just because you are new to the space.
Yeah, there's no question that, especially Sequoia, of all of them, is extraordinary. There's 2,000 VCs. So I'm not saying that all VCs are monolithic, but the brand is meaningful. You hear stories about Google choosing to take money from, I think it was John Doerr, if I have that right, but it mattered to them that they got like strong assistance, strong backing. At the same time, a lot of entrepreneurs are skeptical of VCs, Facebook being famous for being skeptical of VCs because a lot of VCs are also disruptive. What they care about is different than what the founder cares about because they want to raise their next fund and they're much more financial than they are product people.
And in exchange for the money, the VC might annoy, bother, call up every day the founder to see how they're doing, what they're up to. They might want some input into what the founders are doing. And of course, a lot of VCs will take positions on the company's boards and do other things to try to influence activity directly. Do you want to give some sense, by the way, of what your approach to that is in terms of not just putting money into a company, but also continuing to participate in some way or in some capacity in the operations of the companies that you might invest in?
We think we do have some interesting assets to bring to bear. I'm a skeptic of when the VCs replace the CEO. I mean, here I am saying that I'm a CEO, so maybe biased, but if you look at when Bill Gurley replaced the CEO of Uber, Uber's valuation has been flat since that happened, and that's been 5 years, and they went from 0 to 50 billion. So, I mean, obviously there's excesses, but I think fundamentally founders and executives building companies often want to build things that are more long-term, maybe more meaningfully different than something that the public markets might reward in a quick exit. That's something that's very different from us because our investors and I would rather have a good return for a long time than a great return for a short time. If you look at the compounding benefits of high returns, it's way better to stay in. And that's because we don't take 20% of the up, so we don't have to sell to get paid. I also want to address this question of sort of like, well, how much does basically incumbency create a barrier to entry? And so I have a couple thoughts on that. So one is that, again, Cambridge Associates has this study. They looked at basically the returns, again, of these top companies, and they basically found that 40 to 70% of returns realized go to new and emerging venture funds. And so like famously, right, Andreessen Horowitz, who's now the biggest venture firm in the country, started in 2009, right? So they're new entrants. They came in at the bottom of the last cycle right after the great financial crisis. People thought they were crazy to be starting a venture fund at the middle of the great financial crisis. Turned out to be the best time to start a venture fund. The top two of the three largest venture funds in the world also were started in the last cycle. So you're basically talking about it being really common for new entrants to actually come in as long as they have something that makes them different. And another thing I think is interesting is that, so if you look at, they say brand is one of the most valuable or top two most valuable things in the company, brand and then the partners, right? So how big are the marketing budgets of a typical venture fund? Let's take Accel or Insight or Index or any of these companies we probably never heard of. How big is their marketing budget? Probably minuscule. It's probably $100,000 or zero. So our marketing budget, Fundrise's marketing budget is tens of millions of dollars. We have this is one of our capabilities. Our marketing budget, I would bet you, is more than the top 20 venture funds combined. So if brand matters, if brand awareness matters, I think we can make a meaningful difference to that. I mean, we weren't in this space. We're going into this space. And pretty soon, with 350,000 investors and a huge marketing budget, our brand awareness will be high.
Yeah.
And I think if our proposition is attractive, companies will actually put us on the list. If it's all about being in the top 100 companies, then having brand awareness and a better structure is a winning formula.
Yeah. So that sounds like the response to the VCs then is, sure, your brand matters, but our willingness to spend and our ability to spend also matters. And if I can kind of insert myself into the perspective of an investor, one thing I might worry about is just mission creep. Fundrise has been around for more than a decade now. Investors are familiar with what you're an expert in. And prior to Fundrise, you yourself were in the real estate industry. And I think people might hear this and think, well, yeah, they might have some tech expertise, but I want to make sure that they continue doing the real estate investment side just as well as they have in the past. And I don't want sort of things to get diluted that way. So can you kind of tell investors what you would say to reassure them?
Yeah, I mean, I love our investors because they're skeptics. And I myself, on occasion, I'm a skeptic.
That's right. Listen to enough Onward episodes and you'll see that Ben is very much a downsider, so to speak.
So I understand that skepticism and I appreciate it. I actually, in the years of building Fundrise, always had the best interactions with skeptics and sometimes the sort of glandular optimists, the ones that are just go, go, go. I can't even figure out how to relate to them. So I have a few ideas around this, few responses. My view is money is made or lost because of change. And so focus is critical, but narrowness is dangerous. And the two biggest drivers of real estate are demographics and technology. So like on the technology front, we saw e-commerce created billions of dollars of value for industrial and destroyed $1 trillion of value in retail. And now work from home, we believe, is going to create billions of dollars of value in residential and is going to destroy $1 trillion of value in office. So breadth and depth is an asset, not a liability. I think our innovation fund will make us a better investor in real estate too. But just to get the practical side of it, to put it in perspective, Fundrise real estate team's 83 people. And Fundrise tech investment team currently is one person. So tech investment team will probably grow to a handful of people. But when it comes to the real estate, we're clear. We know how to execute, and we have teams and teams of people, and we're growing those teams. And when we get to Kendall, she may have some questions from investors about what the next couple of years look like for real estate. But we always go back to macro and technology, combine macro thinking with great technology products, and we can create better outcomes for investors. So the deeper we get in technology, I think the better off we are and better off our investors are.
Well, I think we should get Kendall in here, but I've got one final question for you, Ben, for this segment of the show, which is just a personal question. What excites you most about starting up this fund, and what are you most looking forward to?
I hadn't even thought about that until you said it, but then it became immediately obvious what my answer is.
Uh-huh.
And that is the idea of learning new things is just so enjoyable. I believe if you look back at tech, right, it's actually all about mega trends. So it was internet, then social, and then mobile, and then cloud. And the next one is AI and machine learning. We're starting to interview ML, machine learning engineers. I'm literally learning about machine learning. I'm starting to talk to companies in that space. I can't believe it's so fascinating. And that's why I think about AI. If AI is even half of what I think it's going to be, of course it's going to be bigger than everything that's come before. And if there's a company that's not using AI 10 years from now, good luck to them. So often I've seen in finance, just doing the work is an advantage. The fact that you actually go and I'll go read a textbook. I actually read AI CPA's valuation on how to value tech companies. My CFO is just I'm so sorry for you. But I wanted to understand, how does the AI CPA value these companies so we can do it the right way? And I wanted to read the source material. And then I tweeted at them, gave them grief because they had this math that was wrong on their way they were valuing a ship. And I have one other sort of parting thought, which is that with so many investors, so many of those investors actually work at the tech companies we want to invest in. We may even have CEOs of those tech companies as investors. So please email us. Many of you know way more than we do. So we want your recommendations, your introductions, your assistance. You're going to be investors if you want to be. That is, I think, a powerful asset for us. And so if anybody's listening, hit us up. We can have a conversation. I'm really excited about sort of unlocking the power of our investor network.
Yeah. Well, we didn't just find out what excites you about this fund. We also got a little bit of an insight into your wonky predilections. Textbook readings on the weekends. Absolutely. All right. That was great. And I think we should bring in Kendall Davis now, head of investor relations and investor operations at Fundrise. And she's going to go through some investor questions with you, and the two of you are going to answer them. So, Kendall, I'm just going to step aside and give you the floor.
Awesome. Yeah. Thank you guys for having me back. I am so excited about the Innovation Fund, and I know we're going to have a lot more questions to field on that in the coming weeks. So definitely would love to listen to any questions you have. Please feel free to send us an email at contact@fundrise.com. We have some questions that are market related, and some of them were some really great questions that actually came as a result of the last podcast. And it's fitting. I was just looking at some headlines that the Dow just booked its worst first half of the year since 1962. So Ben, it looks like some of your predictions are coming true. But following the last podcast on June 15th, the Fed hiked rates by 75 basis points, which of course was the third hike this year and the largest since 1994. And so we had a specific question come in from Charles from Maryland, who was asking, how could additional rate increases impact both Fundrise and the larger real estate market?
Kendall, it's great to have you on. That's a great question, and it's a very frequent question from our investors. So inflation is driving up interest rates. It's not transitory, and that the Fed now is having to essentially overweight interest rates in order to basically tamp down inflation. So interest rates have gone from 2 to 3% to 5 or 6%, and they're likely to go higher. And so that's basically driving down the stock market and driving bond prices down and just collapsing basically asset prices. So our real estate, in particular, our residential in the Sun Belt, which is the primary assets we invested in over the last half a decade, have been appreciating, which is, I think, a lot of people are surprised because they're seeing everything else in their portfolio go down, negative red numbers left and right, and we are up. So far this year, first half of this year, something like 4 to 6%. So we're up and the market's down. Why is that? The reason is that rent growth in the Sun Belt especially has been keeping pace with or exceeding inflation. So our rent growth, even up till this month, has been 8, 9, 10, sometimes even much more. And so last year we had a rent growth of 15, 20%, and we were borrowing at 2%. So far this year, we're seeing 8 to 10% rent growth, and we're paying interest about, let's say, 4 to 5, not 5% yet. So we're still have much higher rent growth than we have interest payments. It's also raising cap rates. So basically, rent growth is outpacing the increase in interest rates and cap rates. So that's where we've been up till now. And that's why our NAVs, our net asset values, have been increasing, because all of that increase in rent growth has been flowing to the bottom line as higher income. The question is, will that persist? What's it likely to happen going forward? So here's a really interesting thing why we love shelter or rental housing in the Sun Belt. So the Sun Belt is the hottest growing part of the country. So it's getting more rent growth than national inflation rates. And when interest rates went up so much, the 30-year mortgage went to more than 6%. So housing became much less affordable, or arguably unaffordable. It was already very expensive because housing prices went up. Now interest rates went up, and now it's much harder to buy housing. So what happens when you can't afford to buy a house? You rent. And so what we're seeing and what we saw is before, when the housing market was hot, the number one reason why someone terminated a lease at one of our properties was to buy a house. At our single family rental homes, which had a wait list before this, it was close to 70% of people who terminated their lease was to buy a home. Because they're renting a home, they want to go buy a house, right? So now we're likely to see much stronger demand for our rental housing because people can't afford to buy. There's really strong counter-cyclical dynamics with housing. It's why housing outperforms stock markets in inflationary environments. There's a lot in there, but we were really lucky, and I think we had the right assets for this economic context.
That makes a lot of sense. So in light of that and sort of the shift in demand for rentals, maybe that answers Charles's other question. So his next question was, where are the biggest opportunities in the coming 1, 3, or 5 years?
So Fundrise is a different kind of investment company than the typical real estate company, just like we're different than the typical venture investor. So the standard developer or private equity fund is a high leverage, hot money player. So they buy, they borrow as much as they can, and they move fast to get high IRRs or high rates of return. And that basically is different than us. We're a lower leverage investor. We're focused on the long term. And what's happened is when interest rates doubled, the debt market basically ground to a halt. So the hot money players are out of the market. They can't borrow money and turn their assets the way they were last year, which means we're one of the few buyers in the market. And what we're seeing already are really meaningful discounts, 15, 20% discounts on the assets we love. And I think we're going to get better and better pricing over the next 6 to 12 months. So we're most excited about the assets we've been in, which is single family rental housing in the Sun Belt. And so we think we're going to be able to buy very attractive cost basis in these asset classes. I'm so bearish on office and retail because of technology, and I'm so bullish on residential and industrial because of technology. So if we can use this to buy really good assets at a better price, we will.
Seems like there's some themes with kind of what you were talking about earlier about how we're fundamental investors. Do you see parallels here between the innovation fund and the real estate market in terms of where we are in the cycle and these opportunities?
Yeah, I was actually looking at multiples earlier today. Look at tech multiples going back 10 years. The exact same drivers of real estate were driving tech. And that was low interest rates and Federal Reserve quantitative easing, which means they were printing trillions of dollars. And it just really drove up all asset prices. So in tech, you saw the exact same companies trading at 2 or 3 times higher multiples. And in real estate, you saw the exact same properties trading at 2 or 3 higher times pricing just because of the Federal Reserve. And that's why I'm so focused on macro. I learned that in 2008. is you can have the best thing going on a micro basis, but the macro will swamp you and crush you and flood you if you haven't prepared for it. That's like a learning I had. And I think everything about how the next couple of years plays out is going to be dependent on what the Fed does with all that money that they have.
Yeah, makes sense. So there's another question that came in from an investor, and we were talking in the last podcast about what it would look like if there was another 2007, 2008 type housing crisis and your views on the fact that was an unlikely scenario to repeat this time around. Sounds like this investor is still curious in what your views might be if the real estate market was overvalued at this point in time. So this is Greg from DC. He said, "Hi, I continue to be very impressed by Fundrise. Thanks for the great work. I have a question. What would be your recommendation in terms of balancing investments with Fundrise for someone whose view is that the US real estate market is currently overvalued?" So I think this has something to do with whether you'd go an income strategy versus
Innovation Fund.
Tell me more.
Wait a second. I was like hearing that question.
I think he's focused on real estate. So maybe you can answer it on real estate. But yes, Innovation Fund's another good option, right?
Yeah. So the Fundrise Real Estate Income Fund is focused on fixed income and debt. And we have a large portfolio of single-family rental that we were looking at securitizing. So I spent a lot of time in the securitization market with an investment bank that we work closely with. And in order to basically learn about it, I said, okay, I don't want to just get a securitization done. I want to actually start seeing other people's securitizations. I want to start, I told them I wanted to buy securitizations. And so I started getting the PPMs, these sort of 600-page documents. You're seeing all these issuances of other people borrowing money from the securitization markets. And then the market blew up and all of a sudden they started getting really attractive. And I said, oh my God, we actually should buy these because you're seeing single A portfolios of 1,000 homes at 7.5% interest rate. And that's really attractive. Just to give you a sense of where that is, you're talking about 70, 60, 50% in the capital stack. So you have 30% of the debt junior to you. It's hard if you're not familiar with sort of capital stacks, how that works. But the pricing in debt markets, I'm seeing AAA rated residential mortgage portfolios going for 5.25%, 5.5% interest rate. And literally 12 months ago, that would have been 1.5%. So basically a really good lower risk adjusted return is that kind of investment. So that's something we're looking at closely. Normally, I don't like the paper market because I feel like it's synthetic. But when it gets dislocated, it's tremendous. It's such a fascinating part of the market.
So in terms of the way that an investor may want to come to our platform and think about their portfolio allocation, what do you think that means for them?
Typically, debt, fixed income are lower risk. I hate to say anything about what's better or less risk because you can't predict the future. But I think, because what happened, just as an example, is the bond market lost 10% of its value. Bonds were supposed to be the safest thing, including treasuries, lost 10% of their value the first half of this year. So you put your money into what's supposed to be safe, but it doesn't protect you from inflation. But I think that the fixed income fund that we have has some really interesting opportunities now.
So we have another question from Jordan from Colorado that I think also ties in with this idea of repricing that's happening or could happen in the coming months. So Jordan asks, how do I know that a Fundrise fund is buying at a good price? And then there's another follow-up question, which I think relates really nicely to the incentive structure that you were talking about with the Innovation Fund earlier. Can you talk about the incentives for doing any deal to deploy investor capital versus buying the right deals at fair prices? He adds, I really enjoy the content around the Fundrise platform. Thank you.
So there's two really big differences between Fundrise and typical private equity fund that do have a history of deploying capital when they shouldn't. And so one is that we don't take a 20% carried interest. We don't take 20% of the ups. So we don't have this incentive to put out money because you only make money by putting it out, right? And the second difference is that we're direct to consumer, DTC model. And so we have 350,000 investors. Kendall probably knows them all. And so that direct relationship with the customer is actually our company value, not the money we have under management. And so if we build trust with that customer, we deliver for them over and over and over again, do the right thing. With 350,000 investors, we have $3 billion of equity under management, right? So that's probably a really small amount of all of their capital. They have all of their savings. 350,000 investors probably have more than $3 billion of savings. So our incentive is to basically do the right thing for them over and over and over again, of course, years. And that's because we have a direct relationship with them. Other financial institutions, you give the money to somebody, who gives the money to somebody, who gives the money to somebody. And if they lose the money, you don't even know who it was. I mean, it's highly intermediated. So it's really meaningful. Poor Kendall and the team will get an earful if we don't deliver. So our incentives are totally different. The way we're structured, I think it's just a better mousetrap. And so we're going to be very careful, especially now. We really have held back investing. We have a lot of capital. We have low leverage. It means we can bring that to bear if we see opportunity. But we're not going to do that until basically we see the whites of its eyes, right? Until we see the bayonets and we're going to fire. So it's a great question. Again, it's a skeptical question by our skeptical investors, and I appreciate it.
Well, I think, getting back to your points earlier about having evergreen funds and not having those sort of 18 to 24 month timelines like the VCs you were talking about earlier.
Or any private equity fund.
Absolutely. It really makes a huge difference. Well, those are all of our questions for today. So I really appreciate you taking the time to answer those, Ben. I know our investors do too. And once again, if you have any other questions, please feel free to reach out to us at contact@fundrise.com. We'd love to answer them on the podcast. Thanks again for having me, Ben.
Thanks, Kendall.
And that wraps things up for episode 5 of Onward, the Fundrise podcast, featuring Ben Miller, CEO of Fundrise, and Kendall Davis, Fundrise Head of Investor Relations and Investor Operations. My name is Cardiff Garcia of Bizarre Audio, and we invite you to send your comments and questions to onward@fundrise.com. And if you like what you heard, please rate us on Apple Podcasts and be sure to follow us wherever you listen to podcasts. This podcast was produced by Seaplane Armada, who also did our music. Thanks so much for listening, and we'll see you next episode.